Hello, Matthew Bell with InsurancePrescription.com. Today I want to continue talking about annuities, and in specific I want to talk about annuity settlement options. In very general terms, an annuity is a retirement product offered by an insurance company that has the purpose of trying to guarantee that you don't live too long. And while it sounds weird, the idea there is talking about longevity risk, that is to say, outliving your money. An annuity, in principle, is supposed to provide the promise of a guaranteed lifetime stream of income. Now, they are complicated instruments, or at least they can be, and they're somewhat tricky to think about. I have a number of different videos on these, and an annuity in general is broken up into a pay-in period where you are funding the annuity. You might fund it in a lump sum, one time. You might fund it in installment payments over time. And then there's a payout period, and that's what we're going to be discussing today. Now, there are really two main ways of getting your money out of an annuity. The first is to cash out or surrender the annuity. Now, this is not really a settlement option, but I felt that it was appropriate to at least mention it in this context since we're talking about the payout period. We're talking about the period of time when you're taking money from an annuity rather than putting it into it, and cashing out is an option. If you cash out your annuity, essentially you are taking a lump sum. You're taking the money out that you put into it, possibly with a little gain, but you do have to remember that cashing out or surrendering an annuity might subject you to various surrender charges or other fees. It's worth bearing in mind that an annuity is not supposed to function as a short-term savings vehicle. So it's not designed and it is not ideal for you to be putting money in to try to get a particular rate of return or to try to get a particular interest rate and then take it out in a year or two. You're almost certainly going to lose money in that situation because the annuity is designed as a long-term savings vehicle for retirement purposes. But a lump sum essentially in this respect means that you are taking the entire value of the annuity out, closing the annuity down, and then doing something else with that money. As with any of the settlement options that we will be discussing, cashing out, taking a lump sum may have tax consequences. Part of it is going to depend on the tax qualifications, if any, of the money. If it was tax qualified as an IRA, for example, then none of the money was ever taxed. And if you cash it out in order to transfer it, let's say, into a savings account or a checking account so you can spend it, then you're going to owe taxes on that money. If the annuity is non-qualified, for example, then that would mean that the money you put in had already been taxed, but the gain is still subject to tax, and a Roth would be somewhat in the middle of the two. You would have been taxed on the money that you put into it, your cost basis or your principal, but the gain, even though it hasn't been taxed, in a Roth would be able to be taken out tax-free. But you're going to have to discuss these finer points with your tax preparer. This is not intended to give tax advice, and in fact, this is not intended to give advice of any kind, retirement advice, investment advice. This is simply for general informational or entertainment purposes only. If you need specific advice and recommendations, consult a licensed professional in your area. But apart from cashing the annuity out, there are several different settlement options which we will discuss now. Remember that all of this is essentially going to revolve around the fact that an annuity has a pay-in period and a payout period. As a technical point, cashing out really keeps you in the pay-in period. You put money in and you just decide to take money out and close it down almost the way you would a checking account. The similarity is not precise because checking accounts aren't going to have surrender fees, but the idea is similar in the sense that that money is owned by you so long as it is in the pay-in period. To get to the payout period, you pass through a rather peculiar change which is referred to as annuitization. In annuitization, the ownership of the funds in the annuity transfer from you to the insurance company. And it is insurance companies that set up annuities. Now, why would anyone do this? Why would anyone want to change ownership of the funds in their annuity from them to the insurance company? And the answer is because what they get in return is more valuable to them. And mainly, that is a guarantee of lifetime income. So the difference between simply having a pile of money and having a guarantee of lifetime income is the worry-free nature of the guaranteed lifetime income, at least in principle. The idea is supposed to be that instead of relying on yourself and your own investment experience and your own ability and to make sure the money lasts you until the end of your life, you're relying on the insurance company to provide you with a guaranteed stream of income. Now, it's important to remember that the guarantee is predicated on the strength of the insurance company. So if the insurance company is insolvent or is in some way in financial trouble, then its guarantee isn't going to be worth very much. So the ratings on the company are going to be very important. There are third-party ratings companies, and I will get into those in a future video. But annuitization is essentially after it transfers ownership, you're going to be faced with the choice of various settlement options. How do you want to receive your benefits? So now we move from the pay-in period to the payout period, and you have to select how do you want to receive your payouts. Now the actual amount of your payouts is going to depend on the amount of funding, it's going to depend on your age, it's going to depend on your mortality risk. So actuaries working for the insurance companies are going to base their calculations on various annuity tables, very similar to the mortality tables that would be used in life insurance contracts. And it's also going to be based, the actual amount of your payment is going to be based partly on the settlement option you choose. Now there are two overarching categories. The first one is going to be lifetime, and the second is going to be temporary. So for lifetime payout options, it's pretty much the way that it sounds. You are going to be receiving a paycheck for the rest of your life. Now the first option that can go along with that is simply you, as one person, will receive a paycheck for the rest of your life. If you have that kind of an annuity, a life-only annuity, it's sometimes referred to as a pure annuity or a straight annuity. There's only one annuitant. Let's say it's you. And as soon as you die, the payouts are completely discontinued, the annuity is shut down, there is no beneficiary, no survivor. You get an income guaranteed to you for as long as you live, and as soon as you die, the income stream is cut off. Now, why would a person select that? The answer is that the payout that you can expect to receive on this kind of an annuity is the largest, the biggest paycheck that you can expect to get for your money. And the reason is because the insurance company only has to pay one person. But many people are in a position of wanting to guarantee at least something to somebody else in the event that they die. And there are many different ways to do this. One of the simplest is called life with period certain. What this entails is essentially the selection of a period of time that is going to be conjoined with the lifetime payout as a kind of a guarantee. So this kind of an annuity, similar to the life-only or pure life, will pay one person for as long as that person lives. Unlike the pure annuity, if the first person dies, a second person may be eligible to receive payments. And that depends on how long a period of time the first person lived. Let me give you an example. So let's say you have an annuity with a 15-year period certain. That means that if the first person lives 20 years, then they have outlived the period certain, they have received 20 years of payments, and when they die, the annuity is completely discontinued. Let's say, on the other hand, that they have a life with 15-year period certain, and tragically, they only live 5 years. That means that the insurance company will continue to pay a beneficiary for an additional 10 years after the first annuitant died, because they have a 15-year period certain on their annuity. If the person lives 14 years, then the beneficiary would receive 1 year worth of payments. The longer the period is that is guaranteed, the smaller the payments can expect to be. For example, if a person wants 20 years of certainty, then the amount of money they can expect to receive from the insurance company is going to be a little bit less than it would be on a 15-year period. And if they only want a 10-year period of certainty, then the payment will be a little bit more. But each of these with the period certain are going to be a little bit less than what you would expect to get if there were no period of certainty at all. And the reason is because you're paying for these guarantees. Now, a variation on this theme is the life with refund. The way that life with refund works is it's a guarantee that the insurance company will at least pay out what was put in. So it's at least going to return your principal to you, or what's sometimes referred to as your cost basis, the amount of money you put in. So for example, let's say that you fund an annuity with $100,000, and forget about the actual rate of return and the amount of time. Let's say that you end up with $200,000 in that annuity. So you put in $100,000, but at the time you go to annuitize it, its actual value is $200,000. And let's say that at that point you annuitize it, you change the ownership of those funds to the insurance company, and you settle it with a life with refund option. Let's further suppose that the insurance company has promised to pay you $1,150 a month for the rest of your life. Well, $1,150 a month times 12 is $13,800, which is the amount you'd expect to receive in a year. If you die in 5 years, the insurance company would have paid you $69,000. But $69,000 is less than the $100,000 that you put in. If you were to die in 5 years on a life with refund, then the insurance company would provide to your beneficiary the difference, which in this case would be $31,000. Let's suppose, on the other hand, that you lived 7 years. It's simply 1150 times 12 times 7, which gets you to $96,600. Now you're much closer to the $100,000 you put in here, and so the insurance company would owe less to the beneficiary, and in this case would cut that person a check for $3,400. Now if you die in 8 years, the insurance company would have paid out over $110,000, which is more than the money you put in, and therefore there would be no refund. Now notice that the refund is calculated on the principal. It's calculated usually on the amount of money you put in, rather than on the amount of money you put in plus the gain. With the gain considered, the contract was worth $200,000. And you would have to live around 14 and a half years on this math in order for the insurance company to have paid out around about the amount that the entire annuity was worth. So in 14.5 years, at $1,150 a month, you would have been paid out roughly $200,000. I'm making the numbers up here, but the idea is the longer you live, the more money you get, but one of the things that you're paying for is the guarantee of the income. You have no worry about where that money is going to come from, provided the insurance company stays in business. You have no worry because that is a guaranteed paycheck every month. Now, another common way that people provide for somebody else is with what's called survivorship. Sometimes this kind of an annuity settlement option is called joint and survivor, or it's sometimes also called second to die. In this way, the insurance company pays one person until that person dies, and then they pay somebody else. Or, if you prefer to think of it, they pay two people while they're alive, and then continue to pay the survivor when the first person dies. Now, the amount that's paid to the survivor is a percentage of the first payment. There's a first check that goes to both people so long as they both live, and then there's a second check that goes to the second person who survives. That percentage is selected at the time you select your annuity option. It could be 100%, it could be 50%, it could be literally almost any percent, but common percentages are going to be 50, 75, 100%. And in this kind of an annuity might be referred to as joint and full survivor if you've selected 100%, or joint and 1/2 survivor, or joint and 2/3 survivor, depending on the percentage that you select. Now the option you select is going to determine the amount that you get. So for example, if you've selected joint and 50% survivor, let's say that the first check, while both people are alive, is worth $500 a month. Again, I'm making up the numbers. If that's the case and you have selected joint and 50% survivor, when the first person dies, the second person is going to receive a check for 50% of the first check's value. So if you selected a joint and 50% survivor and the first check was $500, when one person dies, the remaining person will get $250 for the rest of their lives until both die, and then the money is exhausted. Let's say, on the other hand, that you say, well, I want the guarantee to be the same amount. I don't want them to have to take a pay cut. Okay? Then the insurance company might say, we will offer you then $375 every month for the rest of your lives. And if the first person dies, the second person will get the same exact amount. Now again, I'm making up the numbers, but that decrease from the first check from $500 to $375 is typical. The higher the percentage guarantee, the lower the payment is going to be. So if you want to select a lower survivorship amount, like 50%, the first check is going to be worth more. So $500, while both people are alive, goes to $250 on joint and 50% survivor. And if you want 100% survivorship, you're going to take a pay cut up front. So that means that joint and 100% survivor might be worth $375 to both people for as long as they live. And you're paying for the guarantee. The higher the percentage of survivorship, the lower the first check's payment. Now there is an uncommon option, and that is joint annuity. And in a joint annuity, unlike joint and survivor, a joint annuity is referred to as a first to die. That means the insurance company on a joint annuity will pay both annuitants so long as they both live, and if even one of them dies, the money is completely discontinued. Now, because of the way this payout is structured, often you find joint annuities pay more. So for example, suppose you and your spouse select a joint annuity and they offer you $750 as opposed to joint and survivor where your options were $500 and $375, making the numbers up. $750 a month goes to both of you as long as you both live, but if even one person dies, the money goes to zero. In other words, when one person dies, the payments stop. Now, why would you select one of these various options? Well, it's going to depend on your situation. And once again, you're going to want to consult with advisors in your area in order to pin down what specific options are right for you. But for instance, if every other thing in your life is already provided for, your basic expenses are covered, you maybe have plenty of money in the bank, maybe this annuity is for vacationing. A person might select joint annuity if they want to maximize the amount of money they get while both spouses are alive, on the theory that when one person dies, the second person is not going to want to continue vacationing. So you want to get as much money out of the annuity as you can. When one person dies, you figure our vacationing days are over, and then you segue into another aspect of your lives. On the other hand, joint and survivor annuities are going to be for those people who want to use the annuity to provide for basic expenses. If you're going to want to provide for basic utility payments to be covered or basic grocery expenses to be covered, there's probably going to be the need to continue the paychecks after the first person dies. Now, whether or not you're willing to put up with a decrease in percentage is going to partly depend on whether or not you want to have a higher amount up front and whether or not you think it makes sense to take a decrease. So for instance, if you figure grocery bills are going to be less when one person dies, you might consider that taking that decrease in percentage might not be all that bad. Now, once again, you're going to want to consult with an advisor on this, and I am ignoring features like cost of living increases and inflation, which should be factored in. Now, I said there were two overarching kinds of annuities. The first one was the lifetime annuity, and that's really what we've been considering. There is a temporary annuity, so sometimes people will consider that you just want a certain amount of money and you want to pay it out every month for as long as the money holds out. Or you might say, I just want a certain amount of time, however much money that buys me. Temporary annuities fall into two different classifications. The first is going to be those that are fixed amounts, and the second is going to be something that's on a fixed interval. Think about a lottery payoff in this respect. A person might say, I want to have the lottery pay out to me for 10 years, in which case the check is simply going to be the total commuted value divided by 10, and that's what you get every year. And when the 10 years is up, the money is exhausted, whether anybody has died or not. Now, if you have died, a beneficiary can be selected to continue receiving payments. On the other hand, you might say, well, I'm not so keen on the 10 years, but I want a certain amount. I want $500 a month for as long as that holds out. Maybe that holds out for 16 years. So you get a fixed amount, $500 for 16 years, and then the money is gone. And if you die before the 16 years, again, your beneficiary will receive the balance of payments. Now, these are what are called annuity certain settlement options. And once again, they're not lifetime. They're for prescribed amounts of time, like 10 years, 15 years, or it might be a fixed amount. And in that case, you might have $500 a month for as long as the money holds out. I know of somebody who elected an annuity certain in order to time their payments with a car. So they took out a 5-year car loan, they had a 5-year annuity certain annuity, and they used the annuity payment to discharge the car payments. But the primary function of annuities is to provide retirement income and to provide it for the remainder of the annuitant's life. That's at least the way the annuity was designed. That was the intent behind it. There are any number of ways to use annuities, however, and I know it can get complicated, but a conversation with your local advisor can help to shed light on whether any of these options are right for you. If you found something of use in this video, I ask that you like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today. I hope something I said was enlightening, and I look forward to seeing you again in another video. Thank you.